What is up, everybody? Crypto Noah back with another video showing you how you can generate passive income on your blue chip and stablecoin cryptos so you can accumulate as much as you can to sell ahead of the next bull market. Today we're going to be covering another vault liquidity manager in Range Protocol. They allow you to deposit assets in there and it manages your liquidity on decentralized exchanges, and as you'll see here, through a couple of other different strategies as well. So before we get started, I do have to say this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like we always say, do your own research, but use this channel as a starting point. So in this video, we're going to cover what Range Protocol is. We're going to do an overview, go through the docs. We're going to go through all of their strategies. We're going to go through their audit. We're going to do a platform walkthrough, and then per usual, at the end, if you stick around, I'll tell you if I would use Range Protocol or not and why. So without further ado, let's get into the content. All right, so if we go on DeFi Llama and we go to liquidity managers, you can see that Range Protocol is number 4. They have a TVL of $26 million, and if we click on it, you'll see that it really started to rise in September. They were at 6 million, now they're at 26. I wouldn't say it's been growing parabolically or exponentially, but it's been growing pretty steadily. So now here we are on the Range Protocol docs. So it says here that Range Protocol is building infrastructure for an on-chain asset management through non-custodial vaults, where sophisticated vault managers can run their automated strategies with transparent on-chain execution. They envision a future where blockchain-based assets are professionally managed on scale comparable to traditional financial platforms. It says they're building the infrastructure for vault managers to run a diverse set of strategies across themes such as Spot, AMM, which are pretty much decentralized exchanges. So they have Uniswap, PancakeSwap, and QuickSwap, where you can, deposit your assets and they'll, manage the concentrated liquidity for you. Liquid staking, and it says automated vaults to optimize the yields across liquid staking ETH derivatives like ST ETH, Lido stake ETH, FX staked ETH, etc. And then they have NFT finance. These last two are coming soon. The most important part, fee mechanism. Let's cover their fees. So it says there are 2 types of fees that managers can charge. They have a performance fee, and a performance fee will be capped at 10%. 1,000 basis points, which is a lot to be honest, and at the time of vault initialization, aka on the deposit, and it will be set to 2.5%. So imagine paying 2.5% when you deposit and 10% of your rewards, and that doesn't matter if you experience impermanent loss or not. So that's the performance fee. Then they have a management fee, and the management fee at the time of vault initialization will be set at 0, but it can be set up to 1%. I don't know, it seems a little confusing here, but all I see is they have a management fee and a performance fee. So yeah, those are the fees, and I do think they're pretty high. Now let's cover their strategy details. So they have 3 types of strategy. You have an active strategy, passive strategy, and a peg strategy. Let's cover the active strategy. So it says Range Protocol brings its proprietary quantitative strategies on-chain and opens up access to all users with its active vaults. An active strategy creates positions in a narrow range and constantly monitors the price action to trigger rebalances and aims to reduce the impermanent loss while achieving higher fees. So narrow price ranges that maximize the trading fee earns. Now, if you experience impermanent loss, just keep in mind that even though they're maximizing your yields, they're getting a percentage through their performance fee. So they're not really incentivized for you to perform well long term. They're just incentivized for you to make high amounts of fees because that's where they get their money from. Impermanent loss mitigated by rebalancing the portfolio to maintain the exposure of the base token every time a position goes out of range. Guys, if a asset is volatile and it goes out of range and comes back down, well, you just rebalance for no reason. So that's why I'm a little iffy on these protocols, especially if they can't show like the history and like all the analytics, like how Gamma does. It says all interactions are automated and prices are constantly monitored every few seconds across different avenues. Passive windows during high volatility periods to reduce impermanent loss and toxic flow. It says rebalances for high slippage pools are optimized with just-in-time liquidity, resulting in swaps with 0 slippage. For more details, you can look at their research paper here, and this looks like it's kind of like their white paper. A lot of math, a lot of pi on here that I'm not going to get into. I'll let you guys do all that. I only like pie on Thanksgiving. No, I'm just kidding. Next, let's cover their passive strategy. So this with passive strategy, the vault provides assets in a wider range around the current price. The position expected to stay within range for a long time. The vault manager may choose to do rebalancing dependent on market conditions. So this strategy is suitable for investors with a low risk profile. So my honest thoughts on this is that if you're going to provide liquidity in a wide range, you don't need a manager like this to do it. You can manage that yourself. If it's going to be in range for a long time, all you have to do is set up the ranges on the charts, make sure it's within the range. If it's not, you just go rebalance. You don't have to pay, all these fees to do that. And if you want to learn how to not only determine which assets to provide liquidity for, how to find profitable liquidity pools, how to track your gains, how and when to know when to rebalance in different pools, and how to master like your technical analysis and fundamental analysis so you can make sure you're getting in and out at the right time. We teach all of that stuff in Know It Alls with our hands-on coaching as well as our course. It goes through everything you need to know regarding yield farming, chart mastery, literally everything you need to know. If that interests you, click the link in the description or visit knowitals.xyz and book a free strategy session with one of our team members. We're going to talk to you, get to know you, ultimately just see if our program is a good fit for you. If it's not, we're still happy to, connect with you, answer any questions you may have regarding markets or yield farming. And we're happy to point you in the right direction if that's what you're looking for. With that said, I digress. Let's get back into these stocks. Next, they have their peg strategy. So peg strategy is applicable for pairs that have strong correlation in their price. These can be hard pegged assets like stablecoins, USDT, USDC, where assets are supposed to be redeemable one-to-one and have a minor fluctuations based on market factors. And then soft pegged like wrap staked ETH and ETH, where assets are correlated based on external factors. In this case, validator yield and the prices follow a deterministic path. So it says for hard peg pairs, the peg strategy tries to provide liquidity in a narrow range. That makes sense. If the price goes out of range, the strategy expects the price to mean revert and does not rebalance. If the price stays out of range for too long, the strategy manager can choose to move the range around the current price based on market conditions. Again, not much management here, but you're paying a lot of fees. This is something you can do on your own. Provide liquidity for ETH and wrap stake ETH. Do it in a narrow range. If it goes out of range for a long time, just rebalance it on your own. And then look at their strategy partners. So it says for active strategies, the vaults are currently managed by our first strategy partner in Toka Labs. So it said that they were using like external people to manage these vaults. So it sounds like Toka Labs is that external company. So if you go to their website, it says we're experienced proprietary traders dedicated to optimizing liquidity and market efficiency in digital asset trading. With a successful track record, we can help take your trading to the next level. So it says they have 10 billion plus in annual trading volume, 50 million in capital deployed, and 20 plus protocol/chain integration. So it looks like they're some kind of investment institution where they integrate with platforms like these. I haven't seen them integrate with other platforms, but they, run these vaults for people or trading, it looks like. But that's pretty much all of the information I can find on them. You can hit blog. It says they hadn't wrote any stories yet. Yeah, so it's like, I don't know who's part of this team. They don't have anything written about them. I mean, it says they have all this fancy stuff, but, I don't know if I would take it with a grain of salt. All right, if you go to their audits, I always say, like, once you're placing your funds in another smart contract, there is risk that it can be hacked and drained. So you want to make sure that there is multiple audits where they assess the vulnerabilities, because it's not enough to just get an audit. You need to go back and fix the things. And to be honest, even if there's an audit, there's a chance of things still happening. Like you saw Radiant and Gamma get hacked just last week. So if we click on this, they had audits by multiple different firms. You can kind of go through it. This was April 26th. Let's see if this one was after that. Yeah, so it's taking forever to load, so I'm not sure. All right, now let's go through their tokenomics. So it says RNG will be the governance token for Range Protocol. They say right now there is no token live right now. Any token marketed as Range Protocol could be a phishing scam. And follow the social media, so it gives like all the tokenomics. So this could be an opportunity for airdrop farming, where you use the platform and basically they reward people who use the platform with a token allocation. Gives the vesting schedule, the community team, marketing, private sales, seed rounds. So it gives like the inflation. So around July of this year, it looks like, they're gonna start releasing to the community. At least that's what it looks like. And then if you look at their official links, they have a pretty large Discord community, 21,000 members, 145 online. They have a pretty decent Twitter following and 15,000 followers. They've been on Twitter for about a year, which isn't super long, but it's also not super short. So now that we've went through the docs, we've went through the strategy, all that stuff, let's do a platform walkthrough. And after that, I'm going to tell you if I would use Range Protocol or not and why. All right, so here we are on rangeprotocol.com. Pretty cool graphics, shows you the dexes, real world asset, liquid staking. Oh, they have a real world asset manager that's live. And then that wasn't in the docs. So it looks like just the NFT and the derivatives aren't live yet. It gives you the TVL, the fees earned, the active vaults, shows all the platforms they were audited by, the vault manager. So not just Token Labs, but Time Research as well. Shows their investors, their partners. They're partnered with some pretty reputable projects, but a lot of times in crypto, partnering just means that there's some kind of plugin on the site. It's not really actual partnership. So like Uniswap, for example, they could be managing the vault, but that doesn't mean Uniswap endorses them. I would say unless they're not on Uniswap's page as a partner, I wouldn't really count them as a partner. It just makes them look good. Team overview, it gives some of the things that they did, but it doesn't say who they are. So like I said, take that as a grain of salt, and they have like some FAQs. Let's go ahead and enter app. All right, so if you look here, you can see, remember that I said they have AMM, liquid stake derivatives, real world assets, yada, yada, yada. They're indexed by the category. So let's take a look at some of the spot AMM pools. And you can filter by all chains, which is good. And we want to filter by APY because we got to outperform those fees. So this is a pretty good one here. You have on Arbitrum, BTCB, I'm not sure what BTCB is, and Wrapped ETH get 540% APY. Magic Wrapped ETH, 121%. Let's see if we can what analytics we can view here. So it gives you performance fees, 10%. That is insane in the brain. So it gives you the positions, but it doesn't give you how it performed historically. A lot of ambivalence on this one. Don't know who's behind it. I don't know who are the people running the vaults. I don't know the team on this protocol. I don't know how well these vaults have performed. I would need more, to be honest with you. Let's see what other pools they got. 8 Wrapped ETH, 69%. Radiant Wrapped ETH, 54%. These are all pools where we can show you guys how to manage them on your own, so you don't have to lose 10% on performance fees and another 2% or whatever on management fees. But they got some pretty good pools that they're running here. Let's go back and let's look at the liquid stake derivatives. We're going to filter by APR again. So ST Euro and Wrapped Stake ETH, 76%. Wrapped Stake ETH and Wrapped ETH, 4%. Nothing to write home about. Yeah, these ones are pretty low. Let's look at real world assets. And they have boosted vaults too with rewards. Let's see. So real world assets, let's filter by APR again. Nothing super crazy. The highest one is 76%, and this is on a euro. I would never buy that. So yeah, not many options here. Let's look at lending and borrowing. They only have one pool, 11% APR. Then they have a portfolio page where you can it looks I guess the same thing, but I would imagine if you had something here, you'd be able to see your positions. Now that we've went through the strategies and the platform walkthrough and all the docs, would I use Range Protocol or not, and why? The answer is it depends, but probably not. So let's go through why I would use it first. I would use it to airdrop farm. Airdrop is free money. Imagine if Uber gave you Uber stock just for catching Uber before they went public. As an example, DoorDash. That's the cool thing about Web3. They can incentivize people from using it after they, go public or issue a token. So I would airdrop farm. If they had some rewards that were favorable that I couldn't get somewhere else, because a lot of projects will reward a protocol like Range so that they can incentivize liquidity. If it was a way to where the rewards are outperforming what I can do on my own, factoring in the 10% performance fee as well as the 2.5% management fee, I would do that. Now let's talk about why I wouldn't. I'm sure you guys can guess. Them fees is too high, bruh. Too high fees. I can outperform that a couple times over, and without having to pay 10%, without it saving as much time. You can use something like Aperture to kind of hybrid automate your position, and Aperture doesn't charge any fees. So another reason why I wouldn't use it is because I don't know who the team is. I don't know who Token Labs is. I don't know any of the people behind this. It seems like they're kind of hiding behind something. I don't know. That doesn't necessarily mean that they have not your best interest. But if you're not doxxed and people don't know who you are, it is a liability, and it takes some of the pressure off your back to perform, because you can do something, get hacked, and there is no financial responsibility. So I'm not gonna say it's an automatic red flag, but if founders are anonymous, I'm gonna have to see more things that give me more conviction, and I don't see that here. And the last reason why I would not use Range Protocol is because they are lacking in analytics. Like, all the pools that they have on there, I don't know how they did in the past 30, 60, 90 days last year. And even though past results doesn't guarantee future results, you still want to see how they've been doing. Like, I want to see like what makes them want to rebalance. Like, they said the three strategies on the docs, but if you guys watch my channel, there are other protocols like Gamma that go into way more detail and charge way less fees. So those are my thoughts. With that, I'd like to conclude this video. If you guys got value, I ask that you consider subscribing. I just hit 1,000 today. Help me get over 1,000. I'm trying to go for 2,000 next. Drop a comment, share with a friend. Let me know what projects you want me to cover next, what topics you want me to cover next, and any constructive criticism that you have is always welcome in the comment section. So with that, I thank you guys so much for watching. I love every single one of you, and I will see you in the next video. Take care.